I want to bring in right now CNBC contributor Shannon Saccocia, Chief Investment Officer at Boston Private Wealth, and another CNBC contributor, Peter Boockvar, Chief Investment Officer at Bleakley Advisory Group. It's been a pretty bleakly week, hasn't it, Peter?
For sure.
Actually, stocks ended up higher this week, but I'm telling you, it did not feel that way. Let's go to the question of the Federal Reserve and a couple of the things that Steve just reported out of the mouths of Rosengren and others today about possible more stimulus coming out of the Fed. You're a skeptic on this. In fact, you're more than a skeptic. You feel it's a bad idea.
Because it's not stimulative.
Why not?
Well, let's take financial conditions. What you need with respect to easing financial conditions is not just changing interest rates. You need market participants to take risk. Market participants are not going to take risk to ease those conditions if they're uncertain about the economic environment right now in terms of earnings, cash flow, the direction of the economy, and how far this virus spreads. The other thing the Fed rationalized for why they cut was to instill confidence in households and businesses. I'm not so sure that cutting 50 basis points 2 weeks before a meeting, when you only have essentially six rates to cut, was really instilling any confidence. And the flip side
now
is
suggesting that you're going to cut yet again,
more.
maybe by a quarter, maybe by a half.
Right.
That may be another sign of panic.
Yes, and then let's look at the regional banks. The regional bank stock index is at the lowest level since January 2019. You are damaging the profitability of regional banks, which a lot of small and medium-sized businesses rely upon. That's a tightening of financial conditions.
What may be nice to consumers, lower interest rates, the possibility of refinancing my mortgage, is not good news for those smaller or mid-sized banks who might get squeezed. Shannon, what do you think about the banks right here? Are they investable at these levels? Big ones, mid-sized ones, regionals, whatever?
You need to look at where their income is coming from. Obviously, there's been pressure on net interest income. A number of banks, whether they're larger regional banks or obviously some of the larger money center banks, have made an effort over the last several years to increase the percentage of fee income. We've been in a low rate environment for some time, although we've been hopeful from an interest rate perspective that we would see interest rates move higher. The reality has been in that banks have had to adjust to a low interest rate environment for some time. So I think you need to be thoughtful about where you're getting your bank exposure. I also think that, financials as a sector are trading as if they're all banks associated with the need to grow net interest income. There are great opportunities elsewhere in the financial sector, but you do need to be thoughtful about where you're taking your
So Shannon,
your positions.
walk me through some of the detritus of this fall off and discriminate between the stuff that you wouldn't touch even with a sanitary wipe in your hand, and the stuff that might be getting to a level that you would be tempted to pick it up, or you've already been buying.
In the financial sector, particularly?
No, anywhere.
Oh, in general. So we actually have been buying over the course of the last 10 days or so. We have looked at our portfolio and said, what are the leading franchises, the high-quality names that we believe that even if we were to have a recession, which we think is a very low probability right now, but one we need to factor in, where are those companies that we think have, competitive advantages, that have a sound balance sheet, that have free cash flow that's available to pay back to shareholders? Those are the companies that we've been moving towards. And so we have owned a few names that were a bit more, I would say, tied to this rotation back to value. We've been trimming some of those names off and concentrating our positions in these higher conviction names in our portfolio. So we've been doing a lot of position adding, adding to positions that we already owned in order to increase the concentration in those positions, and maybe taking a few of those that really would have required a reacceleration of the global economy, which we were anticipating mid-year to come, to putting those to the sidelines and saying perhaps we can wait on those as we're not expecting the follow through on that value rotation.
Peter, back to you. Today we had a jobs number that was actually better than many people expected. Should we pay any attention to it? What does it tell you?
It's old news. I mean, leisure and hospitality was one of the key parts of the report that was positive, but we know that's going to reverse. Government jobs accelerated. We know that that's not really a good measure of the private sector. And if businesses are pulling back, then they're going to obviously reduce the pace of hiring. And now, the most important number is watching weekly jobless claims to see if there's any increase in the pace of firings in response to this.